to use classic graphic patterns. Graphic patterns. Flag pattern. The flag pattern occurs when the price corrects after a strong trend in the opposite direction of the trend. This pattern will show the potential of the next trend. Trading volume is very important in this model. Powerful trend before this pattern should be accompanied by high volume. But when the price corrects, the trading volume should also decrease. Descending flag pattern. It is exactly the same as the rising flag pattern, except that it will be created in a downward trend. After the failure of this pattern, we expect the previous trend to continue. Triangular pattern. This pattern is exactly the same as the two ballast patterns, except that the trend line in this pattern is convergent and will create a triangle-like image. The pennant is a neutral pattern and does not indicate the uptrend or downtrend of the next trend. Graphic patterns. Triangle pattern. A triangle pattern is a graphic pattern in which trend lines converge over a price range, generally indicating a continuation of the previous trend. But sometimes they also play the role of a return pattern. Incremental triangle pattern. An increasing triangle pattern is created when a horizontal resistance range is formed above the price and an uptrend line is formed below the price. Whenever the price reaches its resistance level, it is accompanied by selling pressure and the price moves towards the uptrend line and always creates a floor higher than the previous floor. Price will break this pattern by breaking the resistance range and will be accompanied by price growth. Failure of this pattern is usually done with high volume, as shown in the figure. The incremental triangle pattern is an ascending pattern. Decreasing triangle pattern. The decreasing triangle pattern is the opposite of the ascending triangle pattern. This pattern consists of a horizontal support below the price and a downtrend above the price. The failure of this pattern occurs when the price crosses the horizontal support range and trades below it. This failure will usually be accompanied by high volume. After the failure of this pattern, we expect a sharp drop in prices. As shown in the image above, the descending triangle pattern is a descending pattern. Graphic patterns. Wedges. The angle or wedge pattern is created by the convergence of two trend lines. In this model, new ceilings and floors are formed with different slopes, which usually indicates the condensation of the market and the completion of the current trend. The formation of a wedge pattern in the market also means that the current market trend is weakening. Within this pattern, trading volume will decrease and price changes within this pattern will decrease. Wedge rising pattern. As shown in the image above, the rising edge pattern is a downtrend. When this pattern is formed in the chart, we expect the uptrend to weaken and the trend to return to a downtrend. Finally, when the price breaks the uptrend line below the pattern, the downtrend begins. Falling wave pattern. The falling wave pattern is an uptrend. This pattern, like the rising wedge pattern, consists of two converging trend lines. Graphic patterns. Twin ceiling and floor pattern. The twin floor pattern and the twin roof pattern appear in the W&M diagrams. Note that it is not necessary to have both ceilings or floors at the same price. A slight difference in these prices will not reduce the validity of this model. Twin roof pattern. The twin roof pattern is a recurring pattern. This pattern appears in the chart when the price moves twice in an uptrend but does not cross a resistance but fails to cross it. When the price breaks the lowest price between the two ceilings, this pattern is complete and we expect the price to fall. Twin floor pattern. The twin floor pattern is an uptrend. This pattern is exactly the opposite of the twin roof pattern. In a downtrend, when the price reacts twice to a support and fails to break it, this pattern appears in the chart. In case of failure of the highest price created between these two floors, this pattern is completed and we expect the price to grow. is a downtrend. This pattern consists of 3 consecutive ceilings and a baseline known as the neckline. The first and third ceilings should be approximately in the same range, and the middle or second ceiling should be above these two. This pattern is completed when the price can break the neckline downwards. In this case, we expect the price to fall. The inverse, as shown in the image, is the opposite of the previous pattern. This pattern is an uptrend. This pattern also consists of 3 consecutive floors, the first and third floors being formed in almost the same price range. The middle floor or the second floor is formed lower than the other 2 floors. This pattern is completed when the neckline is broken upwards.